Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder back with another ETF Spotlight. This week, we're jumping into the world of treasuries and treasury duration with none other than Joanna Gallegos, co-founder over at Bond Blocks, and we're going to talk about the XHLF fund today. So let's go ahead and dive into the conversation. Joanna, I just want to give us a background of how this fund created and even the suite that you've built over there. Where did this come from? When did you see the need? Were people talking to you and they were like, we need this duration of treasury funds, and you provided? How did this begin?
So we recognized that there was a problem in the current ETFs out there in the treasury space, and that core problem was duration drift. It's a significant issue that I think investors probably overlooked until interest rates started changing so dramatically about four years ago. US Treasury ETFs are a popular and efficient way to gain exposure to treasuries for income generation and portfolio stability. But most of these ETFs, the current ETFs before our target duration ETFs came out, they hold bonds across a broad range of maturities. And that creates challenges for investors who need to keep their portfolios aligned to a specific duration target. So what is duration drift and what is duration? Duration measures a bond sensitivity to interest rate changes. And usually you don't see such dramatic changes intra-year or over shorter periods of time. So a higher duration means greater price sensitivity. The bond's price is going to move if there's more duration in it faster. Managing duration is critical for optimizing returns, monitoring interest rate risk, and ensuring portfolios remain aligned with investment objectives and your risk tolerance.
So specifically for types of investors that are maybe wanting to do treasuries without having to go through the Treasury Direct website and kind of do all that themselves, right? Is that kind of what these funds help alleviate that pain?
Yeah, so in traditional maturity-based Treasury ETFs, duration is going to change over time as the bonds inside that portfolio age and market interest rates change or move. And this shifting sensitivity, which we described as duration risk, it can be really significant. I mean, in 2022 alone, we saw interest rates change 450 basis points. That was pretty shocking. And if you hadn't been paying attention to where your treasury duration was, your portfolio might have been at risk. That's a lot of volatility. So over time, the ETF's risk profile of these traditional maturity-based ETFs, it may move away from what the investor intended. So to counteract this, you have to frequently rebalance your portfolio to restore your original target interest rate exposure. And that may mean you have to sell more ETFs. So if you're not paying attention, you may have had more embedded risk than you were thinking.
Yeah, so let's double down into this fund, right? Because you just mentioned the monthly rebalance. So how does Bond Blocks and the approach to the methodology of the monthly rebalancing of a fund like this, how does that compare against all the other Treasury ETFs on the market? I mean, there's quite a few out there.
Yeah, so we were the first at Bond Blocks to market an ETF that's specifically built to address duration drift and reinvestment risk. So we offer 8 different target duration options from 6 months all the way to 20 years. And unlike traditional maturity-based ETFs, the Bond Blocks US Treasury ETF suite tracks the Bloomberg target duration indices and the funds such that the funds are only holding Treasury securities that are selected and weighted to maintain a consistent interest rate target. So it's I like to say, like, these funds are really easy because they do what they say on the label. So if it's 6 months or 1 year or 2 years, you're getting 6 months duration, 1 year duration constantly. So what happens is the portfolios are systematically rebalanced each month. And this ensures the important aspects that we're trying to deliver, that duration stays on target. The portfolio continuously reflects current market yields, and reinvestment risk is reduced by spreading reinvestment across monthly intervals rather than one large maturity event. So if you're reinvesting and you're resetting that target interest rate and duration on a monthly basis, you're not sort of heading down into really big rebalancing events when certain maturities come up in your portfolio, and that could be a large percentage of your portfolio. The benefits to investors is really straightforward. They get precision of a custom-built ladder without the burden of a constant monitoring and trading.
It sounds like some nice relief right there. So I wanted to ask you, obviously, you've been talking about interest rates and how these funds kind of, people think about the treasury market and we see what's going on with the administration and the swings of interest rates that we have seen over the recent years are not traditionally normal, right? But now you have an administration calling for a pretty significant cut. And you look at the Fed futures and some are saying, well, maybe we'll get there. Others don't. And then you look at the Fed board. Some say we'll get there. Some obviously don't. So how should investors be thinking about this fund if they're saying, well, do I need to be worried about a potential big interest rate swing again in the future? How should investors think about the fund in that scenario?
Yeah. I think given all the uncertainty and, maybe this is the time when interest rates do start coming down, instead of going up, they're going to start coming down. So they went up, they stabilized for a good chunk of time. And now there's a sense that they may be coming down. Every different version of this uncertainty, we've seen investors really stay in the short end because it reduces all of that uncertainty on the long end, which can be quite volatile. So we do recommend XHLF a lot. That's the 6 months target duration fund that we have. And I think it's specific to certain scenarios that investors have that are really important right now. One, it's designed for investors that are seeking ultra short term. And that seems to be a really good comfort space for people. It generates income. Interest rates are still high at historical highs. So they can use this to generate income, manage their cash positions, and maintain liquidity. So being on that short end seems to give them a little bit of coverage of the uncertainty. It keeps them generating income. And then it's a place of liquidity for them where they can come in and out of that space and they're not making any long-term commitments and into the risk of their portfolio. So it's particularly relevant in a higher for longer interest rate environments where short-term yields remain attractive, but volatility management is essential. Even if you think rates are coming down, there's still a lot of uncertainty of how fast and how much. So, for this period of time, it seems to be a smarter place if you're concerned about uncertainty and volatility. Again, it offers a low volatility, low credit risk option because the bonds are backed by the full faith and credit of the US government.
Now, I've got to ask you, though, how is it that you can only, 3 basis points for the expenses? How is it that you're able to keep that cost savings for the end user, for the end investor in a fund like this? Obviously, there's got to be, I know you said it's systematic, but 3 basis points, that's like nothing.
Yeah, one of the things that we observed at BondBlocks, in addition to that duration drift problem of the existing Treasury suite, was also it wasn't updated in price as well. So the XHLF's expense ratio is low. The average expense ratio for the US Treasury space in ETFs is around 14 basis points. And that compares to the average expense ratio of 6 basis points for the US Treasury ETFs and BondBlocks offers. So I think that the reason we're able to offer that is, first and foremost, it's the right price for what it does. It's the right price for what people should be using it for in their portfolio. We want investors to keep more yield that they're getting out of this historically high interest rate environment. And also the ETF structure itself promotes operational efficiency and cost transparency. So we're just really porting through the institutional cost of running this portfolio to investors directly. We think that's the right thing to do and the right thing to do for people's portfolios. Monthly rebalances are handled internally. It reduces the need for investors to bear additional trading or monitoring costs. So as I mentioned, if you're trying to target a certain risk parameter or duration in your portfolio, you'd have to constantly monitor your portfolio and then be trade in and out of ETFs to make it match. So doing this in one-stop shop at a 3 basis point expense ratio is a really powerful tool for investors. And we think it's the right place for that exposure to be on average for our suite, 6 basis points. The 6-month XF is 3. It's a really great tool.
We love that. Thank you so much. So XHLF, let's talk about the focus of the US T-bill zero coupon securities and why this might be a fund that, a lot of people think about money market funds. Like if I need to just do the cash position, I'll just put in money market funds. Why might a fund like this one actually kind of benefit the end investor as well when they're thinking about it in that frame?
Yeah, I mean, it's simple. We went over a few of these points, but it provides exposure to US Treasury securities. It provides a consistent 6-month duration, which is important for risk management. So you understand exactly what the price volatility of your Treasury exposure is going to do. You have an expectation. It delivers competitive yields and with minimal risk. So it's not a money market fund. We would never say it is, but XHLF can serve a similar role in your portfolio, and it often has greater yield potential. The structure of the ETF offers tax efficiency, especially to taxable investors. And as with other ETFs, it delivers daily transparency, intraday liquidity, and efficient portfolio. It's an efficient tool for your portfolio and how you can integrate it into it. And then, certainly all the other things that we think about in real-time pricing and trading flexibility versus money market funds. So it's a pretty powerful liquidity tool if you ever need it, if and when.
All right, so I'd like to ask you, you're deep in the Treasury space with all these ETFs and have been around for so long. So I want to ask you right here, right now, what is next for the US Treasury ETF space?
Well, I think what's next for the US Treasury ETF space is a lot of volatility, a lot of market information. We have things coming up in the administration that people are always looking at what's going on in interest rates. So, having a suite of 8 Treasury products that are duration targeted and specific, I think is an amazing space for investors to move around in response to what's going on in the markets. You're getting a precise, low-cost way to invest, in XHLF in the ultra short side of that. And like I said, that's a powerful tool as you're trying to navigate uncertainty and you want to stay in the short end. Enjoy the income that it's generating. Use something for your liquidity and your strategic cash. And then as investors get more confident about what's going to be happening towards the long end, they're able to precisely move out. Maybe they can take on a 2-year exposure or a 3-year exposure. You don't have to fully go out to the full long end or, right away. So I think just having the 8 ETFs that have each of the years of duration and being able to move amongst them as you want is probably, one of the most powerful tools you may have this year and going forward.
Yeah, well said. So one ETF, you already know exactly where to go. Go look up the next duration of bond blocks ETFs. You put that one in your portfolio and you go out to the 5-year and then the 7-year and the 10-year. It sounds like you have everything already set up there, that ladder approach for as people get comfortable. So Joanna Gallegos, co-founder of Bond Blocks, everybody. Thank you so much for taking the time today to walk us through the XHLF US 6-month Treasury Fund and why it might be right for investors' portfolios. Everybody go follow the symbol here on Seeking Alpha, add it to a portfolio, add it to your watch list. And that'll wrap it up for this week's show. We'll see you again here next week. Take care.